The markets are rotating to this sector, and it's time to move right now. Since November, when the Federal Reserve said they would begin to taper their bond buying and to start raising rates, the markets have been rolling over. The growth and the tech stock darlings of the Nasdaq have been the hardest hit as investors scramble to move their money from growth to different sectors of the market. So in this video, I'm going to break down what the Fed is doing, why the money is rotating from one sector to the next, what sector is receiving most of this new money, and one of the best ways that we can play it. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything that you have learned is wrong. Now, today we're talking about, of course, the Federal Reserve. We've been talking about the Federal Reserve, how they create inflation and then deflation, and how that moves the markets. Today we're talking about what they're doing to deflate the markets on purpose and why the money is moving from one sector to the next, and of course, what we can do about it. So, of course, we first start with the Fed. The Fed is fighting inflation, which is sort of funny. It's sort of ironic because they're the ones that create inflation. If you remember from some of my earlier videos, you know that inflation is increasing the monetary supply. So when they artificially increase the money supply, we have more money chasing the same amount of fixed goods and services, and prices start to rise. And then they have to then fight inflation. How do they do that? Well, the opposite. If injecting money, increasing the monetary supply increases inflation, then you have to suck the money back out. You have to decrease the money supply, which is why I have this syringe here. You can see increasing and decreasing it. So what they said that they are going to raise interest rates 3 times. If they raise interest rates, less people borrow. And if less people borrow, there's less money created into existence. Remember, on a debt-based system, the Federal Reserve does not create money. The Federal Reserve creates reserves for the banks, and then the banks make loans. And when they make loans, that money is created into existence. When you go buy a house, a car, a boat, anything like that, and you take a loan, that money is created into the system. So if they raise interest rates, less people borrow, less money is created into the system. Also, what they want to do is they want to taper their QE, the quantitative easing, the amount of reserves they're giving to the banks. They want to do that, the amount of bonds they're buying. And then even they said potentially start to do quantitative tightening. All right, now here's from Investopedia. We can see how do governments reduce inflation. And it just says that when the economy grows due to increased spending without accompanying increase in the production of goods and services. So they created a bunch of money, about $8 trillion in the last 24 months, but we don't have more goods and services to match. And so we have more money chasing goods and services. Prices rise and the currency within the economy is worth less or worthless than it was before. Now, down here, something I've been talking about, there are many methods used to control inflation. Of course, don't put the money in the system would be the first one. But it says confronting inflation through wage and price controls can cause a recession and job losses. So that's something I've been talking about. The third scarier option, price control, something to watch out for. But we can see here, like I always say, take these guys at their word. Fed Chair Jerome Powell says rate hikes and tighter policy will be needed to control inflation. So interest rate hikes, as I'm talking about, tapering of monthly asset purchases, bond purchases, and a smaller balance sheet, which is the quantitative tightening. Those are the 3 measures that they are talking about doing. Now, when this happens, when they've gone from stimulating the market and having inflation or prices, asset prices, consumer prices going up, now they're sucking money out, then we'll start to see deflation. What happens is money starts going to different places. You need to understand there's different ways to invest. I like to call it my 4-pillar blueprint. There's 4 quadrants to the market, and depending on what's happening with inflation or economic growth, then you want to invest into one of these 4 quadrants. And so when we have inflation that they're going to try to tackle to come down, economy slowing down, we want to rotate our investments to another sector of the market, which is what we're seeing, a market rotation. And so what we see right now is tech stocks are crashing. Of course, Facebook got smashed, Netflix got smashed, but it's even worse than that. As a matter of fact, about half of the Nasdaq, which is the tech stocks, about half of those stocks in the Nasdaq index are down by 50% or more. So tech stocks are crashing, and like I said, the markets are rotating, moving money from one side to another. Here's a little example of what I'm talking about. So this is called sector rotation. And so if we're at a market bottom here, and as we go up into a market peak, the types of investments that you would go into would be different. And so for an early bull, if you're an early bull, so at the bottom of the market and in this rising, that's financials, technology, and discretionary. So technology, tech stocks. As we reach the market peak here, what the market likes to see is industrials, energy, and telecom. Energy is a big one. We've been talking about that. Commodities, minerals, metals, and things like that. And of course, then as it starts to roll back over, we can look at a different sector of the market. This is kind of the same chart. It's a little bit more color coded so you can see. But again, in this bull market, the technology does really well. Once we get to the top, we want to cycle into other parts of stocks. And of course, we can see, if you're paying attention, all the headlines have been saying the same thing. Here's Bloomberg. Tech stocks marks biggest rotation to value since 1995. Are you paying attention? Are you seeing the sign? Tech stocks rolling over, rotating into growth stocks over and over. And what we can see here was an interesting article. We can see here that the rotation is here to stay. Stock hedge funds have upped their value exposure to the highest in at least 4 years. So all the big hedge funds are rotating their stocks from growth into value. It says that it's not a one-day rotation. This is the beginning of potentially a 6 to 12-month rotation from growth into value. The market has reassessed the risk of the monetary tightening, and I think the market now is right. Get out of growth, go into value. Rising rates, an upshot of strong economic growth, drive investors towards value stocks. Rising rates. What did the Fed say they were going to do? Raise rates. So, as it says here, rising rates drive investors towards value stocks, which tend to be more cyclical and offer near-term cash flows. So we're looking for things that provide cash flows, things that are good values, not 50 times PE ratios. That is not a good value. We're thinking about 6 times, 8 times, things like that. So let me show you what we're looking at here. All right, so the investors see it, right? The investors are seeing this rotation and they're not totally being faked out. Now, one of the signs that that these investors are seeing this and not really being faked out by the market is gold. Gold is always one of these inflation hedges that we want to look for. And so if we can look at gold, we can see what's going on. And what's interesting is that we can see here on Bloomberg again, gold holds near a 2-month high ahead of the Fed policy's decision. So even though they're saying they're going to tackle inflation, gold is still holding up. But why does that make any sense? Because Mark, gold is typically a good inflation hedge, and if they say they're going to bring inflation down, why would gold be holding up? Shouldn't gold be breaking down? Well, that's a good question. Let's take a look at that. First off, if we look at some of the technicals, now you guys know I am not a trader. I don't recommend it. Technical analysis is it's kind of like gambling, in my opinion. I know. Prepare. Give me the hate mail down below. And also, I'm just going to let you know, if you get a message from me on Twitter or Instagram or YouTube asking you how your trading is going, it's not for me. I'm not a trader. All right. But what we can see here is in this pattern right here, we have this breakout, and it looks like it's about to break out to the upside. Maybe, we don't know. Again, I mean, that's kind of like reading tea leaves. What I rather do is look at the fundamentals. And it looks like there's a whale, a big whale. A whale is a giant buyer that's been snapping up gold below 1,800 and has been defending that position. So let's take a look at that. So what we can see in this article right here is that even though in the past year, the modeled value of gold based on a regression study that includes the dollar, real rates, and ETF holdings. And so what we typically want to look at with gold is real rates, not interest rates, but the actual Fed fund rate minus the CPI, which is the real rates. And we want to look at that. And we can see that it's dropped nearly 10%. But even though that regression model has dropped by 10%, the metals price has only fallen about 2%. Clearly, there's a big buyer who considers the metal a long-term hold. Who could that be? Well, wouldn't we know? Such a whale activity, which shows up neither in ETF holdings nor in futures positioning, would require a substantial buyer, because when you're buying this amount of gold, it shows up somewhere. Typically, it would show up in an ETF. Yet vault holdings reported by the London Bullion Market, LBMA, which includes both ETF and some central banks owned metals, show only a fractional increase. So who's buying this gold? How could they be buying so much as to keep the markets propped up? Well, that would suggest that whoever's buying is able to buy in scale, leave little footprint in the market, and then take delivery and store the metal in a secure, invisible vault. Who could possibly do that? And that points strongly towards a sovereign buyer. A sovereign buyer is buying massive amounts of gold and looks like potentially trying to defend this $1,800 position. Central banks normally declare to the IMF the amounts of metal that they have on their books. So normally they report that. Of course, they want to tell the IMF how much gold reserves they have because of Basel requirements. Between 2009 and 2015, China reported that no change in their holdings, only to reveal that it had bought 53 million ounces of metal over that period. So China, no surprise, isn't totally honest or transparent with what they're doing in their financial system. China has been guilty many times of buying gold and not reporting it until many, many, many years later. And could that be the case? We can see that is happening. Now, why gold and why gold miners? Now, I started talking about sector rotation out of growth and into value stocks. So let's take a look at this. So gushing cash flow. Today, as I said, growth at 50 times multiples is not really a good value. Maybe something in the 6 to 8 range would be. And here we go, trading. We see gold miners, not gold. Gold just sits there, does nothing. Gold miners actually produce something. That's why Warren Buffett hates gold. Gold doesn't do anything. He bought Barrick Gold Mining because mining actually produces something, and they gush cash flow. They're trading the cheapest multiples ever. As a matter of fact, median of the 50 largest gold mining companies have a 7% yield. Now that's value. That's real value. It's the highest free cash flow in history. FCF, free cash flow. It's the highest we've seen in history. Let's look at a couple of these charts here to show you what I'm talking about. So what we can see here, here's on Forbes, seeking free cash flow, gold and precious metal miners have got you covered. Now it's not just gold, this is commodities, this is nickel, this is copper, this is all those things, these base metals that are needed to expand the electrical grid, to produce electric vehicles, to put new charging stations in. It's more than just gold, this is precious metals. Gold and precious metal miners have got you covered with free cash flow. We can see here another headline. Gold and silver miners are generating record amounts of cash flow. And if we take a look at a couple of these charts, we can just see right here, here's gold and silver miners. This is the median free cash flow yield with enterprise value. And look at this cash flow has just been going higher and higher and higher. They're literally gushing cash flow. Why? Because everybody's been into tech stocks, everyone's been into growth, and everyone's been ignoring value. When do you want to buy? Well, it's good to buy what's hated, but it's also good to buy something that's just starting a trend. Gold's been out of favor for the last year, and it looks like it's just starting a trend. Again, we can see the cash flow estimates are going through the roof. We can see the same with the silver miners. This is the median free cash flow. The cash flow has just been going higher. Of course, we can see down here in 1995, way negative, and look at this trend of it going higher and higher and higher. And as a matter of fact, we can see that today we have the 73% of miners have positive free cash flow. They are literally sitting on records amounts of cash. All right, now this is one big, majorly underinvested area. So what does that mean, underinvested? Well, what happens is you have kind of 3 layers. So you have like the explorers, they're the ones going out and looking for the gold. Then you kind of have the junior miners that are the ones trying to get the gold going. And then you have the major producers, the Barricks like Warren Buffett bought. What happens is it's typically an acquisition spree. And so when the majors need more gold, they go to acquire juniors. But we haven't seen a lot of that. As a matter of fact, it's been way underinvested. The M&A, the mergers and acquisition cycle, hasn't even started yet. As a matter of fact, we can see that illustrated on this chart right here, the gold and silver miners M&A cycle. And as you can see, we're barely even getting off the ground right here. We are basically flatline. This is the last time that gold peaked in 2011, and you can see how big it was going here. And here we have not even got it started, all right? Hardly any deals going through. Now, what does that mean? Well, they're underinvested, they're underfunded, they haven't been doing these M&A deals. So as we're not at the top, we're at the bottom of this trend. And as the price of gold continues to go higher, then there's going to be a mad scramble to bring these deals. So let me show you one example here, a prime candidate that I think is poised for this M&A spree that's going to happen, not just in gold, but in precious metals overall, like I said, nickel, copper, silver, etc. Now, warning, disclaimer for you watching this video. Thank you for watching it, by the way. This is a promotional video that I'm doing on behalf of Star Peak Mining. I am not telling you to go buy this. This is for educational purposes. This is a trend that's happening. I showed you the charts. You want to find a way to play this in value stocks, in mining, precious metals, commodities. And this is one that I think could be a good candidate. So it is I'm just letting you know that disclaimer ahead of time. Now, I think this one is ripe for acquisition because of the size of the company, but more importantly, what they've built and the track record they have. So let me show you a couple things. So first, they've been building a very sizable resource, and what they're doing is, so they've discovered it and now they're starting to get it ready, like I said, to that next stage of acquisition, and they have had phenomenal success. And so what they do is they start drilling sample holes to see what they have in there, what kind of metals in there, how much they have, etc. And what they found is that they found that 9 out of 10 holes that they've drilled have had success. Now, go to GDX, which is a stock, and you can look at the basket of all the mining stocks and compare that success record, a 90% success record, with any of the other positions in there, and I don't think you'll be able to find that. So it's a phenomenal success. You can see Star Peak is here in Canada in one of the best mining districts in the world, right around all the other best mining areas that are around there. So it's sitting in a very good area. Now, on top of that, it's better than gold. Like I said, this isn't just about gold. This isn't just about precious metals. They are sitting on a VMS, which volcanogenic massive sulfide, which is basically, well, it's the holy grail of mining. What does that mean? Well, it has all these different minerals all within it. So Star Peak is not just a gold or silver mining company. With the VMS that they have, the Holy Grail, they have all the different types of minerals. And this is very, very rare. As a matter of fact, there's only 350 of them in all of Canada, which I said is one of the best districts. They have gold, silver, iron, nickel, titanium, niobium, copper, and zinc, which is all the things we need for the EV boom, for the infrastructure projects, to rewire, build charging stations, all of those things. You can kind of see an example of that. And you can also see here the example of this volcanic complex. And so all throughout here is this volcanic complex. This is a neighbor property owned by Amex. We'll talk about that. And their property is sitting right here. And of course, like I said, they've hit the Holy Grail. They have that. It's not just gold and silver. We have all of those metals to go from. Now, I always love to look for something that's following success. I say that success leaves clues. If someone else has had success, we do the same things, we should have about the same results, and that's exactly what's happening here. So the Star Peak property is sandwiched right between other successful properties. So the new metal property is sitting right here, and it's right next to Amex, which is a very successful property, and some of their other properties that Star Peak already has. So it's sandwiched between some of their existing very successful Star Peak properties and the Amex exploration. Now, Amex, which is right here next door, has been having massive success. As a matter of fact, they just did a bought financing deal for $35 million, and their stock has gone up over 6,000%. 6,000%. It's like a cryptocurrency or like a penny stock in just 3 years alone because of the success that we've had. And this Star Peak deal is mining right next to that. Again, success leaves clues. On top of that, I always like to look for the team. I always want a championship team. Whenever I'm investing into private market deals, I want to make sure I'm not the smartest person in the deal. I want to see there's other successful people there. And if I'm investing into a company, I want to see that the team founders have also had success. Now, if I want to copy the success of Amex, which is next door, then it might make sense that we would actually use the same drilling contractor that Amex used. They're the ones that had success, so why not use them? We can see that the founder of Amex joined Star Peak. So the founder of Amex that had 6,500% returns has joined Amex. Success leaves clues, bringing the championship team over. They brought the same contractor, and it's been funded by the Amex shareholders. So the people that made all the money, who were smart enough, the smart money that made the right deal, have now come over and funded Star Peak as well. As a matter of fact, between 38 to 40% of Star Peak is owned by both the management and the institutions that invested into it. So that's one of the things I look for, skin in the game. Are they invested themselves? And of course you can see that is. And then the best thing is, because, as I said, gold was kind of loved, but now it's been hated, we have a chance to get in lower than the smart money. So smart money was able to buy at those higher prices, and they thought that was a good deal. We have a chance to front run them, a chance to get in front of them, in front of that smart money, which I think is a good deal. Now, in summary, I showed you the charts, I showed you the headlines. The markets are rotating to value. They're done with the 50 times valuations that don't have any revenues, don't have any profits, don't have any free cash flow, continually need to borrow. As rates go up, if they need to always borrow, how can they keep borrowing? How can they roll that debt over? So it's moving to a different sector of the market that's value, ones that are actually producing free cash flow, like gold miners, precious metal miners that are gushing cash flow, literally, commodities, things like that. So it's rotating to value. The commodities are accelerating. As a matter of fact, you can see this chart right here. This is the United States commodity index fund right here, and you can see that is just at literally sitting at an all-time high at this point. Commodities are that hot. We can also see, like I said, that metals are going to be in high demand. Not just gold and silver, which I do expect gold to have a very good run, but all the other metals, because of the boom, the electricity boom, the solar, etc., is going to have a high demand for that. And it's a way we can get crypto-like returns on metal. You know I'm a big fan of Bitcoin. A lot of you don't like Bitcoin. You'd rather stick to gold. That's great. Using gold miners, precious metal miners, commodity miners, you could potentially get returns like cryptocurrencies or penny stocks if this is more your thing. Of course, I like both, which is why I talk about them both. But what do you think? Do you like gold and precious metals, and I should say precious metals and commodities, other metals? And do you think they could produce the same returns on crypto, or would you rather just stick to crypto? Let me know in the comments down below. I'd love to hear from you. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, that's okay. Give me a thumbs down. But either way, give me a comment and at least let me know why. And that's what I got for you today. All right, to your success. I'm out.